when we see someone who's very successful, you want to emulate them. Take someone who is in great physical shape and is a bodybuilder, and you really like their body. Now you want to copy their workouts. You want to copy what they eat. It doesn't work like that. That's not going to work for you and your type, and you can't just get to where they're at. You're going to get injured, or you're going to gain a lot of fat given, how they've trained up to be able to consume that many calories and all the things they're doing around that. In the same way, some of these jiu-jitsu experts make things look so easy.
I know.
You try to do that, you're just going to get, your bones broken if you're not careful. It's the same, I would say, with real estate and even with companies. We all want to build a Blackstone style company.
Hey everybody, this is the Yield Coach Show. I am your host, Ian Brown. Every episode we bring you dynamic entrepreneurs, real estate investors, business leaders, and inspirational guests ready to open up, share their story, the good, the bad, the ugly, so you can gain advantages, learn lessons, and accelerate your own success. Very excited today. A couple housekeeping items before we jump into the interview. We have opened our doors at Yield Coach Capital to outside investors. Feel free to go to yield-coach.com and you can jump into the investor portal to see any offerings and stay up to date. All right. Today we are quite fortunate. Bear with me for just a moment. I want to make sure I don't miss any bio information here. We have Mr. Zain Jaffer, and he has a very impressive background, so bear with me. All right, we have Zain here. Zain founded Vungle, which is a company that was acquired by Blackstone in 2019 for $780 million. Since then, he's been investing in real estate and proptech startups. He is currently a partner at Bluefield Capital, which is a multi-billion-dollar private equity and real estate fund. He has a very large unit count of 10,000 or more across multifamily, senior housing, student, hospitality, and industrial warehouse. That is very impressive, Zain. Welcome to the show.
Thank you for having me on.
Awesome. So I got a little starstruck by your bio there. So we're gonna have to peel back the onion a little bit, learn about you. I don't think we've ever had anybody on the show with that type of assets under management and that kind of background. So tell us a little bit about yourself.
It sounds like an overnight success. I can promise you it wasn't. I started out as a teenager just obsessed with computers. It kept me out of trouble, and I just tried to hack things together and build basic websites and make money. And it feels like 100 failed projects till you finally hit success. And for anyone listening, you only need to be lucky once. You only need to find one big deal and it can be a life-changing outcome. And I got lucky. The timing was right. See, mobile apps were taking off, and people didn't really appreciate how big mobile apps would become. At that point in time, the iPhone was pretty new. We're talking the 2010, 2011 timeframe. And I had this crazy idea. I thought, why not show video ads on mobile phones? To most people, that sounded like a ludicrous idea. At that point, you had mobile apps that were, you could play sounds like a cat going meow or someone farting. You had a bunch of different flashlight apps. People just couldn't see a future where people are going to want to consume video content on mobile phones. But I hustled hard and I built a platform, and we timed it perfectly with the growth of smartphone penetration. And that company grew. It felt like overnight, but it certainly wasn't. But it grew very quickly and ultimately got to $400 million plus in revenues under my leadership. Was profitable and ultimately was acquired by Blackstone in 2019, 2018. We got the cash in 2019 for a big amount, as you said. So
that's amazing. So did you come from a family of entrepreneurs, or were you like a tinkerer? You like computers? How did you end up, making your own product and leading a company to 400 million?
I came from a family that was quite poor. They were refugees that fled East Africa when there was pretty much the equivalent of genocide happening in Uganda. This dictator, and he was reclaiming everything and wanted foreigners out. And there were a lot of Indian people. by Indian, I mean brown Indian, not necessarily native Indian, right? Brown Indian people from India who were indentured laborers who had basically helped the British Empire expand and build railroads. And so I had, an ancestorial line that part of it was in East Africa. And everyone had to flee overnight and move to the UK. Both of my parents neither have any education. And I grew up in an area that was not the safest place, I felt. It was a melting pot of different cultures, but it was also a pretty violent upbringing, a lot of gangs around, and it wasn't a great place. And computers, like I said, kept me out of trouble. I was obsessed with martial arts because you had to survive, right? But also, my other life was seeing all the potential by having access to a computer wired into the modem cable and having high-speed broadband. Just the things you can see blew my mind. See, at school, the role models I had were people that were gang leaders and a number of friends that ended up in prison for crimes of various degrees, right? There was no real role model that was around for me. But at nighttime or even straight after school when I plugged into the internet, I would suddenly be on these chat rooms with other people building projects, and you realize, wait, I don't get it. The place I go to school, and we barely had a stable roster of full-time teachers. We had a lot of supply teachers, right? The things we were learning and learning in quotation marks, right? And the role models we had just didn't compare to here. I'm seeing Yahoo grow, and I'm seeing Google suddenly come out of nowhere, and Facebook grow, and I'm thinking, this is such a different world. And so that's where my inspiration came from, really. It was being plugged into the internet and having access and ending up on the right side of the internet too.
Yeah, it kind of opened up a whole new world. I mean, it did that for a lot of people, but your story is much more extreme. And I just have to ask, what are your martial art passions?
I used to do a range of things. Started off with karate and taekwondo, and then moved into Brazilian jiu-jitsu and Muay Thai. And got my rear end kicked so much, and I decided I had to stop whilst I was running my company because I'd be limping into the office with a black eye or my arm in a cast because I didn't tap when I should have tapped in an armbar, right? And someone really close to me finally said, like, dude, what are you doing? You're trying to run a potentially multi-billion-dollar company. CEO can't be limping into the office looking like he got into a street fight in San Francisco. So I also felt too, like I'm approaching my 30s and this is not sustainable. And you need a rest because it's high octane, high adrenaline. And if there's not enough adrenaline running a company, traveling, having no sleep, the last thing you want is your cortisol levels to get out of whack, which they did for me by going extreme. A lot of people like to work hard, play hard, but there also needs to be some doing nothing, and having something more restorative. And I didn't have any of that. Even the yoga I did was like hardcore yoga,
Yeah, well, I am 40 and I got back into jiu-jitsu. And at the time of this recording, I'm just a blue belt, nothing too advanced, been training for a few years, but can't sleep on my left shoulder ever since I've been back in jiu-jitsu. And if you're watching this, behind me is this nice comfy pillow tucked into my back because it is screaming. Because yesterday we trained a bunch of, I do 10th Planet. We trained a bunch of twisters, which it's like a spinal tap twist. So we don't train that like full speed per se. I mean, you could, but even just going through the motions, I'm like, oh my God, that was unwanted chiropractic. So no, I understand why. It's interesting because I feel like it puts me in the habit of doing hard things and doing things I don't want to do. And there's a very like hard but reliable progression to it that I'm kind of addicted to, in addition to like the self-defense combative stuff. But you're right. You only have so much like adrenaline in a day, and I have to be careful and I have to give myself enough time. I try not to train more than 3 days a week. When I did this 8 years ago, actually 10 years ago, I started, then I had an 8-year pause. I would train 5 days a week, and it was hard, but I could do it. I wouldn't even attempt 5 days a week right now. So, all right. Martial arts. I love it. I had to go down that rabbit hole. There is something about individual sports or martial arts where by having to develop yourself systematically and just color by number, follow the steps, commit to a process, most people come out better on the other side. So I'm a big believer.
You see a pattern, and I probably am not a great example because I quit too early with jiu-jitsu. I didn't progress. But great people that have achieved success also have a passion that they dedicate themselves to. And often it tends to be in the athletic realm. It could be a yoga practice, it could be a martial art, or it could be a different type of sport, or it could even be something like running. But whatever they do, they go hardcore at it. And that's a trait I think is common amongst people that achieve a lot. They're high achievers and they want to push themselves. The things I learned from just going and rolling around in jiu-jitsu were more helpful than anything I learned going to school, because you really learn how to channel your energy, what leverage really means, right? Mm-hmm. Think about leverage in a real estate context or in a company context. Well, think about leverage being applied to your bones.
Exactly.
Right pressure, you can achieve a lot.
Yep.
I still have dreams. I'm doing some type of martial art, and I definitely think I want to get back into it at some point. But I also have to be realistic with you can only do so much, and rather than setting yourself up for failure by doing 10 different things, just pick a few things and do them really well. And it's hard to say goodbye to the 7 different things on your list you want to do. But life is about focusing and specializing. I really believe that. You can be a generalist in some things, but if you want to be world class or you want to be your very best, you have to put in that time, and you have to be okay dealing with what becomes diminishing returns. You have to work 10 times harder to get that next 10% improvement. But that's the fun about it,
Mm-hmm. I like that. That was the analogy, the light bulb or the laser. And, a light bulb, and I tend to be a little bit more of a light bulb, but, you light up a room, but you can't light up very far. A laser, you can shoot that laser, right, very, very far. So I think it's a pretty straightforward analogy. But I do agree, in business and in investing, a lot of times it does pay to be a laser, not a light bulb. I kind of came from a family more of like Renaissance behavior and a little bit like a menagerie, a hodgepodge of kind of liberal arts education. And so when I got into real estate and investing, it forced me to like funnel down and narrow down and tighten up and just do the same things over and over again and not get distracted. I'm still susceptible to the shiny object syndrome big time, but we're actually recording right now I bought an office building down by the beach and converted it to 4 short-term rentals. I'm sitting in one of them now. And even this project was a little bit of a distraction. It's been about a 10-month project. It needed fire suppression, needed to pull up gas, had to do a change of use, had to work with the zoning and planning department and architect. And so it's nothing a lot of real estate guys, don't do every year, but I just did it without a partner. It's in my backyard, and I did it as a pet project that I'll probably hold on to forever. I like how it turned out. However, this project, it took a lot of the year, and I probably could have done 2 or 3 larger things with partners. At least my shiny objects are still in real estate. They used to just be totally wildly unrelated. But to your point, this was a little bit of a light bulb play, not a laser play. But there's pros and cons for sure.
There's a lot to unpack there. First, real estate is a $300 trillion asset class. Just pick a niche, okay? Mm-hmm. That niche you pick, if you succeed at it, you'll do very well. A lot of pros who are listening are probably smiling now when I say this next part. There are so many deals to be had when you find someone who went into a project, got overwhelmed, and needs to get out because it was more than they bargained for. And when you go into something, you have to appreciate this, right? If you're not going to go into it full-heartedly and plan for the contingencies, you can get hit so hard if you're not careful. And this is the thing, you can't do real estate part-time. You can invest part-time with other partners, operators, but you cannot own and operate your own real estate part-time. You have got to go in there and you have got to learn and you have got to you've got to earn your stripes, to use a jiu-jitsu analogy, right?
Okay.
And then you eventually. It doesn't just come overnight. And yeah, a lot of folks listen to a podcast. They sometimes take the advice literally and aggressively go out. They start bidding on things. They get something under contract. Now they're over their skis and they don't realize, didn't realize there was a lot of zoning and re-permitting and reuse required here. I didn't realize that these tenants are delinquent. I didn't realize buying something at this price range where the price per square foot seems amazing or the cap rate seems amazing. Didn't realize that there'd be plumbing issues in an old building. Didn't realize the roof needs to be repaired. Didn't realize that the electrical wiring situation here is a disaster. I also didn't realize that I can't just go and call up a bunch of contractors, because when I do, those contractors say, we're not coming to that building, we haven't been paid in the past. Suddenly you realize, wow, that $200,000 I was going to put into CapEx is now 1 million plus, and there's all these other foundational issues. I need to sell this at any price and get out. That is such a common scenario. Mm-hmm. And that's why when you go into real estate, start small, pick a niche, learn the ins and outs, build process around that, and repeat and repeat. And if you just do that and you stay patient, you can make such a big amount of money and provide great value to everyone involved too.
I agree, and I don't know if you do any brokerage or if you ever did any brokerage, Zain, but it's a very similar approach to commercial brokerage. If you try to be a generalist, you're going to get washed out. No, you will never be top of mind because no one associates you with a particular asset class. I have a couple of friends, actually 2 of them have been on the show, but Eric Bumgardner is a top industrial broker here in Jacksonville, so I just gave him a little name drop shout. But I remember when I totally remember when he wasn't thrilled about being the industrial guy. And then now, so it's such a good asset class. He's selling so much commercial real estate in Jacksonville, top producer in Northeast Florida. And then I have a friend, I'll give him a shout, John Rutherford. He's one of the top apartment brokers here in Northeast Florida. And I just saw it in our daily record. He just closed a $29 million deal yesterday. And these guys are just crushing it. But Eric should not be selling apartments, and John should not be selling warehouses. And they did just like you said. They learned every corner, every owner. I'm sure they just cataloged everybody in Excel, called, met everyone they could. Eventually, they have the whole Rolodex and the whole market. But you can't do that overnight. And that's kind of to your point. Stay in a niche, laser down, and just stick with it.
There's a temptation for us to reverse engineer role models. When we see someone who's very successful, you want to emulate them. Take someone who's in great physical shape and is a bodybuilder, and you really like their body. Now you want to copy their workouts. You want to copy what they eat. It doesn't work like that. That's not going to work for you and your type, and you can't just get to where they're at. You're going to get injured, or you're going to gain a lot of fat given, how they've trained up to be able to consume that many calories and all the things they're doing around that. In the same way, some of these jiu-jitsu experts make things look so easy.
I know.
You try to do that, you're just going to get, your bones broken if you're not careful. It's the same, I would say, with real estate and even with companies. We all want to build a Blackstone style company, right? We reverse engineer the wealth of some of the most successful fund managers and real estate investors, and we see they have such a huge diversified portfolio across the US. They have hotels, they have apartments, they're doing construction. We're easy there. Like, that takes time to build. You don't become Warren Buffett overnight. And someone like Warren Buffett, you don't even get there in a decade. It pretty much takes a big fraction of a lifetime. And most people don't have that patience to get there. The other thing I would point to is when you said, or you built up my point about having a niche. I made a fortune, especially for our shareholders, with that almost $1 billion acquisition for my startup, right? I got there by being very laser focused on, I would say, a niche within a niche, okay? Our company, if I break it down to you, is going to sound like a joke and very tiny. But this is what I made a lot of money doing. I would find casual mobile phone game developers. Casual games are just, they're not hardcore games where you're doing a lot of first-person shooting or whatever, right? They're sort of turn-based often, and you're basically finding a bunch of casual games that people like to play, and you're showing video ads for another game. And those games are those games are basically paying you, right? It's no different than someone coming onto your podcast and trying to promote their own podcast. Okay, if they're paying you for that, that's okay with you. You're going to make a lot of money. Well, that's how I made that money too. So you've got casual games, and what's being advertised are hardcore games, where these games are not free. People are paying a lot of money to basically go and buy things inside of those games, buy guns, start shooting. First person, or hardcore shooters were really popular there too, or gambling casino apps. That's all we did, really. We had a bunch of gambling apps, casino apps, advertising some really casual games that people play, like Angry Birds or whatever. And we built hundreds of millions in revenue just doing that. That's what we did. Okay.
Wow.
We tried to go out and get Coca-Cola and Pepsi, and we tried to build our app base. So it wasn't just casual games. We wanted to have every app showing our ads. Every time we tried that, we'd get our butts kicked by other players who were good at that. So we just decided I'm really good at just showing video ads to casual gamers and advertising hardcore games, and that was it. No different than finding a zip code or 2 or 3 zip codes and being the person that knows that zip code very well and does one single asset type and rinse and repeats and slowly expands what you do there. That's the way to make money, not trying to do everything at once. You will fail if you do that.
Yeah, and I think personally, I've kind of built a brand of problem solving. I have a legal brokerage and appraisal background, and so people will just call me with things that are problematic or they're not sure what to do about. And a lot of times that can lead to an opportunity, like, oh, here's a solution, or we can buy your problem, or we can partner with you, things like that. So people seek me out, just for a look. I'm not that old, but just for somebody that I'm coming up on 20 years in real estate, not, enough to where people are like, okay, what has this guy seen? I've got an appraisal question, a legal question, a brokerage question. I did title and escrow for 7 years. Sometimes I just have questions about like the title and settlement process and wire transfers and what's the title policy and what's protected, what's not protected, blah, 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 clauses and PSAs. But to your point, I think that your reputation can be niche too. Like, so it's like your investments can be niched in mile deep, inch wide, but you kind of got to be careful with your reputation too, because if people didn't know me as a real estate guy, or not just a real estate guy, like somebody who like has a diverse real estate background and can kind of solve problems for people, I bet more than half, I haven't looked at it, but more than half of the deals that I've personally invested in the past 6 years came to me that way. They came to me that someone called me that was like, you know what, I think Ian might know what to do with this. I know there's something here. There's usually an issue with the stuff that I buy, but usually the issue is the opportunity if you know how to tackle it. So, but I'm just piggybacking on that niche and that depth concept, but more through like your reputation. So
exactly, there's a trend as a limited partner, which basically means my family office invests in numerous different fund managers and projects. I can tell you, limited partners want exposure to things they can't get anywhere else. If you're going to come with the same product everyone else offers, no shortage of national US multifamily, right? They're better off placing their money with someone with an amazing track record who's been in the game for a long time and can deploy large amounts of capital. And that lends itself to larger established players who have earned their stripes, have earned their belt, have probably been in the business for decades, have probably managed hundreds, if not billions of dollars. So what limited partners look for, and I'm telling you this as someone who is an active investor in real estate, I consider myself more of an investor than a developer because I'm not the best at developing. I partner with others, right? And I have to earn my stripes and belts. But as an investor, I want to find someone who's going to give me access to something in my portfolio I can't get anywhere else. If you really understand this segment of the market, it could be strip malls, it could be gas stations, it could be repurposing offices into short-term rentals, right? If you can give me access to that, that is interesting. And I don't have that in my portfolio. And as someone that manages a large amount of money, right, I need diversification. I need some alpha in my portfolio. And I've got money that is okay being invested and has to be invested in things like that. This analogy is very real estate focused, but I also want to give an analogy in the startup world, because it's a sexy area to it. It's very different to real estate. But I started the venture capital fund at Bluefield Capital. We've invested in over 20 proptech startups now. And that is a very niche venture capital fund. It's a strategic venture capital fund. We sit within a real estate group, and all we do is we invest in startups that are selling real estate technology, right? I decided to do that rather than setting up a generalist fund for the very same reason. When you look at the venture capital landscape, there are three types of VC funds. There are the very large tier one VC funds like Sequoia, Andreessen Horowitz, Accel Partners, Kleiner Perkins, right? These guys have been in the game for a long time. They get an unfair share of deal flow. They get the best access to advisors, and they get the best access to LPs. That's what everyone wants to invest for general exposure to venture capital. Then you have everyone else. Everyone else is in the middle, okay, trying to be like Andreessen or whatever. They're second tier, third tier firms. They are the VCs that founders go to after Andreessen and Sequoia has looked at them and said no, right? So where do you play? You can't try to emulate Andreessen and everyone else as a top tier fund. What do? You find a niche. You become the guy who maybe, you work in a commercial brokerage, for example, right? And you want to set up a VC fund. Well, you're going to be the guy that knows how to sell to commercial brokerages and what agents want. And that's your play. Now, LPs are going to come to you. Anyone who's going to Sequoia is also going to come to you because you're a strategic investor, right? You might be someone who sells enterprise software. You might be someone who's an expert in a particular type of biotech. In my case, I'm an expert in proptech, right? When you do that, then you have a niche and you stand out. You can access LP dollars easily. You can get the best deal flow from investors, and people are going to come to you. You're going to be the guy that's known as the niche guy, the proptech guy. You stop trying to be someone or something that you haven't earned the right to be yet. And you can make a ton of money, a life-changing amount, just by focusing on a niche. So there's no point trying to go all the way upstream. And I've seen in venture capital, there are so many companies in the middle who are just not sure what they want to be. And they want to be everything. And that's how you're likely to fail. You got to pick the corner you want to play in.
When you, and you're so well-versed, I have to ask, I mean, I've done all of my deals with just no more than one partner, really just partner up, do a deal, local bank. We either have the money ourselves. We might get like some secondary mezzanine type debt, but not as much of like your traditional syndication or fund. And that is something that we're geared up to start doing in 2023. I have a couple of deals, one under contract that should close first quarter next year. A lot of industrial land in Florida that's just really hard to come by. We've got a really good price on that. And a couple other things we're looking at. What's your advice? Because you're right. There's a lot of people in the middle, and small groups. A couple employees, and I'm more of an operator, active investor that is essentially starting to open our doors to outside capital. I want to be authentic, like you said. What is my niche? What are my superpowers? I'm in Jacksonville. I have this background. Here's my vision. I've turned this type of property 10 or more times. Like, what advice would you give, somebody in our position?
So I think the question you're asking is, once you figure out the product you want to focus on, what are the skills and what function do you want to play? I believe real estate comes down to three things. You're trying to find good deals, you're trying to raise capital, and you're trying to operate the asset. Don't try to do all three. Okay, see where you want to sit. Mm-hmm. If you're the best at raising deals, why are you going to? So if you're the best at, let's say you're the best at finding deals, right? If you're the best at finding deals, you don't have any business, and you're going to be unfocused if you try to also raise the money and also try to manage the asset. So you're good at raising deals, either find partners who are good at the other two areas, or maybe you have vendors who are amazing and you can trust on the operating side. In that case, if you have a great property management firm or you have a great GC who can come and do the construction, that's fine, right? But ultimately, your superpower is raising or finding good deals. If you're finding good deals, focus on that. And then you have the opportunity to decide what function you want to play. Once you find this deal, what do you want to do? Do you want to syndicate this deal to someone else? Do you want to resell the deal and assign the deal to someone else instead, which is a common thing. I see that a lot. I will get approached by groups that said, we've got this under contract and it's a really good deal. You're going to love it. We've already tied it up. We'll sell it to you at this certain price, right? So you decide to do, you should see what your skill set is and what function you want to play. If you're good at raising money, then maybe, you find a group that's good at managing, or you find a group that's good at finding deals, but you go raise the money. You go and do all the LP relationship building, and you spend all your time doing that, and you become really good at that. But I'm a big believer in you find partners who can complement your weaknesses. It's extremely rare to find or expect yourself to do all three. You can try to do all three just to figure out, at the beginning, at a small scale, what do I like? If I don't know how I want to break into real estate, my advice would be start small and try to do it yourself so you learn. Do you like managing the property? Do you get a buzz out of finding efficiencies? Do you get frustrated when the tenant calls you up at 2 a.m. in the morning saying my toilet's flooded, and you're like, oh, just open the thing and just pull the lever up and it will be fine, right? So figure that out and get deep into a project, a small one to start with. And once you figure out what you enjoy and what you don't enjoy, go look for partners that are really good and are the best in their area. Eventually, let's say you happen to be this rare diamond who can do 2 of these 3 things or 3 of these things really well. It won't scale. By the time you are seeing some success, you're not going to have any bandwidth, and you're going to start dropping the ball everywhere. You can't manage the property and keep finding deals and underwriting deals and evaluating deals and raising money and going out and golfing around and building relationships with LPs and answering questions and dealing with all of that. You've got to see this as a business ultimately, and decide and bring in partners. So I'm a big believer in finding partners.
Well, there's a lot there, and you said it very succinctly and very well. I think that, I have a lot of thoughts on that. It's funny because you mentioned the 3, and I essentially just tried to be like the triple diamond on the deal that I'm literally recording from. I found it. I found a private investor to lend all the money on it. I rehabbed it. I managed the rehab. Now I'm sitting in it, and I'm going to probably operate it. And it's like, but you're right. There's no way I could do this like 6 times a year or 10 times a year, 20 times a year. No way. And so to your point, well, let me pause there for a moment. So somebody did what I just did in this project that I'm sitting in. You would have learned what you like best. Did you like finding this? Because you made a good point. I had to find it was a high net worth physician that funded the acquisition. I paid for the rehab. He funded the acquisition. And I'm about to operate it. I already operate some Airbnbs, but you're exactly right. What was your favorite part? If you're going to scale, who's going to replace 1 or 2 of those prongs so now you can actually run? I will say, even though it sucks to do all 3 and try and do that triple diamond hat trick, you're right. You will learn. I think it's kind of wise to do something small and controllable enough to where you can do all 3, even if it's tiny. I did. My first deal was like a $40,000 crack house flip. I mean, I did all of it, and it was back when you could buy bank-owned property. And I hated the renovation management. So what did I learn? Like, I'm sitting in a property now. I did not swing a hammer on this property. I project managed, but everything was my favorite vendors that I've gathered over the past 7 years. And but I learned in that first deal, I don't like to personally renovate property. You might see me paint a wall here and there if I have a day off, but no, it's not my jam. And I'm better off doing this, talking to people like yourself, networking with my friends and brokers and lenders and high net worth individuals that either might bring me a deal or want to participate in a deal. So I think that was the way you said it with the 3-prong, incredibly clear. I like to listen to these episodes while I'm driving. It's always funny to hear myself, but I know I'm going to pause, rewind, and listen to that one more time. That was great.
Yeah, and I'll add something else just to dive deeper into those 3 prongs. The one part I think you can outsource is the operations, but it depends how deep the operations go. If you're doing deep value out of ground up construction, then you need an amazing GC. But if you're just buying something that is stabilized and you're just planning to reduce the rent slightly, you can bring in a third-party management firm usually. What's much more difficult to outsource is finding the deals and raising the money. Those 2 things, eventually when you scale, I tend to find most people that go into real estate, the big guys, they quickly realize, look, we need to operationalize and create processes around the management and operations. We either bring in third parties and vendors we trust, but we have to have on our founding team or at the top executive level being the best at finding deals and raising money. Those two things is where I think the most leverage is when you're going to focus on anything. The other thing I would say too is if you're not sure what you want to do and you're not sure what your skills are, it's not just going into a project and doing all three to learn. You're going to gain so much experience that next time round, you appreciate what it means to manage and operate an asset. You won't be taken for a ride if you've already experimented on a small scale. If you can make money on your first project, that's great, and you should underwrite to make money. But more important than money is the learning experiences and the contacts you're going to build. Once you realize you've been screwed around by a couple of painters and they did a sloppy job, or you start to learn what floating floors mean, and all these weird terms you didn't know before, right? You're going to have a leg up against someone who's just going in for the first time, but you've already earned your stripes there. So there is a lot of benefit to operating and managing. I just have a bias towards believing that eventually should be outsourced, or you hire a team that does that. There is not that much value to be made. Margins are often very, very thin. Now, it depends on your product. Some products are very operationally heavy, and that's cool. But most people listening to these podcasts, I think, just want to get exposure to real estate and graduate from buying a single family rental to eventually maybe going multifamily or more commercial assets. Of course, if you've got a really funky idea, you want to do conversions where you convert retail or big box space into something else, or co-living stuff, right? That's going to be much more heavy on the operations side. And I know a lot about that space because I invest in startups that want to do that. They start off as management companies and then say, look, we figured out how to juice the returns of this asset class. When we manage an asset, we're 3 times more efficient. We operate at higher EBITDA margins. I got one company, right? That's a tech-enabled property manager. Started out with just single-family rentals. They're called Poplar Homes. We were one of the early investors in the company. And they've now bought 15 other management companies and rolled them in because they've built tech and they've operationalized that. So you can make money doing the operations. But if we're talking about yield, where the money I really believe is in finding good deals and raising capital.
Yeah, I totally agree. Because if you can't control what I'm learning with, if you can't, I'm in a capital raising mastermind right now. I'm enjoying it. We got a January meetup and I'm looking forward to it. Let's say you find a good deal with great margin, like you've been able to do, I've been able to do. If you don't control your capital, you're at the mercy. You're just like you're at the mercy of whatever the capital is going to. Well, the capital is going to come in and just take all your margin. It's going to take away your yield. It's just all going to go to the capital. Versus if I can find a deal with margin and yield and control the debt, my capital. Well, now I can actually leave something in the deal for yours truly. If you don't control both, because if the deal isn't juicy enough, you can bring in really attractive capital to a thin deal. That's not good. Now you're going to have angry investors and there's still nothing really there for you. You really need both. A good deal, good capital. So, I think it's just something I agree. You need to be good at both of those. And maybe it's 2 people, 3 people, but I don't think that should be outsourced. Operations, especially, I like your point. Short-term rentals it's more of like a hospitality product. So it's kind of an art form, but traditional long-term rentals, traditional retail, triple net stuff, medical, storage lots. We have, I got an 83 unit apartment in Georgia, third party management. They do a great job. We check in once a month for an asset management call. But to your point, some of these deals you should not be spending too much of your time on. The time you spent was finding the 83 unit deal, finding the lender, bringing in a little bit of mezzanine and letting it do its thing, and then go out and do it again. I'm curious, Zain, your mindset stuff is phenomenal. How did you go from being a tech guy? I know you had a big buyout. Were you like, now what? I need to place this money somewhere. Is that how you got into real estate?
Yeah, interest rates were very low. I was also sitting on hundreds of millions of dollars in cash. And I had to also pay a lot of taxes, but because of COVID, the deadline to pay your taxes was pushed out an extra year. So I had 18 months of cash I'm sitting on in the bank with low interest, and I wanted to put it in place somewhere else. So I started out firstly by wanting to get into real estate. And my first journey was I want to start out on the debt side, learn how that works, then go up the stack into the equity side. So I started out by doing some first senior secured positions, almost like a mortgage lender on some projects with operators who are very good. I would give them a better rate than they'd get with a bank, with less paperwork. And I learned a lot doing that. That's a full-time job itself if you're just doing lending and hard money lending too. I did a lot of. You really need to know the product. You need to look at the assumptions. You need to get progress pictures. You need to go visit the site. I realized, okay, I'm getting good yields doing this. Back then the yields were from 7% to 15%. I would say there is a strong correlation between risk and reward as well. Right. So I was looking for things where the loan wouldn't be outstanding too long. 3 months, 6 months to be able to refi and get out. There were some projects where I lost my temper. I'm like, we've been in this for a year now and I got to pay my taxes. And this is money that I've lent out on a short-term basis for that. So that's one thing I started out by doing. Next, I started listening to a bunch of podcasts, figuring out how to break through. And I started buying single family rentals. So I bought a bunch of single family rentals in San Francisco, and then I realized, there's an arbitrage opportunity that's local to my market that I've discovered. What I discovered is that there are a lot of condos in San Francisco. And condos, you also get something called TICs, tenant in commons. Pretty unique product to heavily urban, densely populated areas. I think you have this in New York and you have this in San Francisco, where legally each unit isn't legally a unit. When you buy the unit, you're buying a fractional share of the whole building. These types of products trade at a 20-30% discount. So I figured, interesting. I can go and buy a bunch of TICs. There's risk with the TIC. Here's the risk. You own a fractional share of the building. You don't own that unit. You own the right to live in that unit. The risk is if something's wrong with one of the other units and repairs are needed, all owners have to chip in. So as you can imagine, the sale price is lower for two reasons. People don't want that. People want to know this is my home and I'm responsible for it. The second thing is lenders don't really like that product. So there's a lot less lending available. So I'd go out and I'd buy these properties all cash. I'd be paying like $500K a unit perhaps, or like $400K a unit, $600K a unit, right? Then I'd bring in a really strong operator I knew who did corporate furnished rentals. And I'd be getting... I'd be buying these buildings and renting them out with a 6, 7, 8% yield in San Francisco, which is insane for a cap rate if you look at it like that, right? Stabilized cap rate. Would furnish it, would rent it out to companies. That product has still done very well for me, even through the pandemic. I'm just shocked that the rents were still getting, our rents are 1/3 lower, and at one point they were half lower, which hurts. But when I underwrote these deals, I knew like, okay, worst case, I can sell it. And even if the market goes down, there's a loss. But I'm just planning to hold these products for a very long time, maybe forever, as San Francisco real estate, and it's going to be cash yield. So I did things like that. Then I started looking at other operators, and I invested in 30 different projects, often as the largest single LP. My idea there was, if I'm the single largest check in this project, I can probably get a share of the GP, or I can get very preferential terms. I'll ask for a higher preferred return. I don't want to pay as much of an acquisition fee. And I became a reliable, dependable partner for some operators. And I'd write, multi-million-dollar checks, made their life very easy. And I'd get superior economics rather than diversifying. I invested in self-storage units and a lot of affordable housing. And I started to pay a lot of interest to affordable housing. And then I started buying buildings myself. And I bought 5 buildings in Texas, all cash, 400 units in tertiary markets, though, I must say. And those were, distressed deals that I would add a lot of value to. Now, when some time passed, I still had a lot of capital left to deploy that I wanted to deploy into real estate. I obviously deployed most of my money to stocks and bonds and some other alternatives, right? But for my real estate bucket, I still had more left to deploy. Then I reluctantly started investing in funds and opportunity zones. And when I invested in funds, I was like, oh, here I am. And I'm now going to be paying acquisition fees. And I'm not the largest LP anymore because it's a fund, for example, right? I'm paying these acquisition fees. I'm paying carry on the deal. I'm paying an asset management fee. I'm also paying a construction management fee. I don't like this, but I'm going to do it because it's part of diversification. You wouldn't believe what happened 12 months later. 12 months later, when I got the returns, I'm like, wow, I'm actually making more money by investing in these third-party funds than I am actively managing my own real estate. How is that the case? One of these funds, I was so just shocked at, like, even with all these waterfall fee structures that exist, my net return in yield is higher than anything else I'm doing, and your product's safer. Your product's Class B in the US. Look, I wanted value if I'm going to deploy my money, and I'm going to run out of money very quickly if I'm buying $100 million buildings, right? I can only do a few of those. Whereas if I'm putting my own money, I can go and buy buildings that are $5 million, $10 million a piece, right? Or maybe 15, 20 million max. So that's going to mean you're going to have to go to tertiary markets, and you're going to have to go after some value-add component. It was a lot safer investing in these, larger funds. And that's when I decided to join one of those funds. I said to myself, I said to them, I don't get this. Your returns are so good, and the asset class is safer. I want to join you guys, and I want to put a lot more money in, and I want to learn how things are done. And that fund was called Bluefield Capital, which has historically, since 2014, generated an average net IRR to LPs in the 30% range.
Whoa.
I know, crazy, right?
Yeah, that's awesome.
And they are very conservative too with underwriting. And I thought, this is where I want to learn. And I realized it's not for me to actively manage real estate. I wanted to enjoy my lifestyle. I want to be on a beach enjoying my time, or I was on a beach enjoying my time. And I'd get calls from the property manager, and I'd have 24 hours to decide something. And then I've now got to fly over to some random place in a rural area and deal with the headache because the property manager isn't performing. I mean, how many of those situations I dealt with drove me nuts? So being a people gave me exposure to how they do things. And that's when I realized how private equity really works. And the game is really rigged to help the larger funds. They are always going to get the first call when it comes to deals. They already have sellers they've done business with, right? They're dependable. All the banks want to work with them. They have the best brokerage relationships. I mean, all of these things together just gave them an unfair advantage versus your mom and pop investor moving to that asset class. And we're not talking, Bluefield is nothing like a Blackstone, right? When we buy deals, it's still $10 million to $100 million in size. That's a range where large private equity firms historically haven't been. And they've also focused on the Sunbelt areas in the Midwest US. And they've deliberately, their play was always this. We want to be one of the largest institutional buyers in a place no one else is. So look for markets that aren't hot but have good, solid fundamentals. And that's just worked so well for them. So well for them. And all they do is they bring together all the pieces. They're the best at finding deals and raising money. They don't do any management themselves. They do partner with GCs, and we do build things. But that recipe and knowing the team has those skill sets has allowed them to grow and now go into hospitality assets around the US and senior care facilities, industrial warehouses. We're doing build-to-rent townhome construction. We're doing multifamily. We're looking at new types of asset classes too. But we figured out the formula, but they didn't get there to start with. They had to build their way up and do a few projects at a time. Mm-hmm. I'll give you one more anecdote. I sold a building, really nice outcome for me. Right? Especially as I had no leverage. If I had leverage, it would have been an insane outcome. But, I made about 50, 60% on the sales price in a very short period. I sold it to a buyer, and that buyer owned everything in town. And they were able to buy this and underwrite it and pay more than anyone else because they own all the properties locally. They know that zip code, and they like it. Guess how they ended up there? They didn't end up there because they were smart and they knew the market was going to take off. They just picked a zip code. They picked a zip code. They bought something there. That worked out pretty well. Oh, the building across the street's for sale. If we buy that building across the street, we can now get scale because our management cost is going to be less. And we don't need two leasing offices because they're across the street. We can just combine them together. They just kept doing that over like a decade, until they became the only large institutional buyer in town, and they were willing to pay prices no one else was willing to pay, but they could make they could extract a lot more value from it than I could. And so that's the benefit of being focused.
Mm-hmm. Yeah, and they pick up the economy of scale. That's a good I like that last real estate anecdote there. You said so much, honestly, it's really quite impressive. But in the sake of time here, I think it's smart, like you said. How are they able to pick up that property? You make a big profit, but it still works for them.
Yeah.
Well, you start getting these efficiencies of scale. You start bringing in management, like you said, to one area. And of course, one building fills. Well, if it's the only building you own, you just like stop answering the phone, but if you own a bunch of buildings, one filled, just water falls on down. It's a beautiful thing. It's also part of the rationale why I'm skeptical about third-party management that also owns. I don't mind third-party management that's all they do. But especially in short-term rentals where you're moving people every night, and somebody might call, I'm ready to pay $6,000 a month for a short-term rental in your zip code. You're like, oh my God, I want them. But Ian's got a vacancy, so do I, and I manage Anno, and it's going to go to his. So kind of got to watch for that.
There are definitely conflicts of interest, and you have to be very mindful of that. You've got to do a lot of deep references to when you're going to go hire a management firm that also owns. Their pitch sounds very good at the outset. We're just like you. We're an owner. We know the pain. We know how other management companies only optimize on the top line, but they don't care about the NOI or the cost. Yeah. We've got the experience. We've got the contractors. It's all BS, man. You've got to be
it, man. We're like you.
Yeah, you've got to be skeptical, and you got to trust no one, and you got to verify. You can trust but verify.
Yeah,
and if you've got that personality, you'll be okay.
I like that you went from. I think your journey is quite interesting because you were in an outside field in technology. Not a lot of real estate guys, developing apps and selling marketing space, and certainly not being picked up by Blackstone. And then you kind of went straight into being really more of an active investor. Or really, really active asset manager, whatever you want to call it. And now you've gone full passive. You're a big LP. Sounds like you're even more than that in your fund. And your fund has 100% third-party management. And it's really an interesting – you have a very interesting real estate investment narrative.
It's a unique journey. Everyone's journey, when you zoom in, is kind of weird. It doesn't make sense at the time, but the dots eventually connect. And obviously, I've geared a lot towards technology. So within the real estate operations we set up a venture capital fund too. And I figured out that's my niche. I'm really good at understanding the technology aspects of real estate. But you've got to figure out what your superpower is. Find a niche and focus on that. You can go broad to start with to learn, but start small. But eventually, try to think about those three things we talked about, which is it's about finding good deals, it's about raising capital, and it's about management. And I think more value is to be had on finding deals and raising money, and you can outsource the management unless the product demands that. But you'll find your way eventually, and just get started like that. That's sort of my conclusion, I'd say.
Yeah, no, those are honestly professional words to live by. I hope everybody's taking Zain's words to heart. You're further along in your journey than I am, in all candidness. I may never arrive to some of the vantage points that you've had, but I completely agree with that 3-prong approach and becoming a black belt and in one or two. But don't be a white belt in any of them. I know we're stuck on jiu-jitsu, but just so people know, it goes white, blue, purple, brown, black in jiu-jitsu. At least get yourself up to like a blue belt in all of them. Yes. And largely, like Zain said, no one's going to be able to stump you or smoke you or trick you if you're at least a blue belt in all of them, and then become that master, that black belt in one or two.
Can I also add, a lot of folks that have done martial arts but might not be familiar with jiu-jitsu. I did karate growing up, and I got almost to a black belt. And, there were like 15 different belts, and you get belts in like 6 months. What does it take to get a blue belt? And how long does it take a black belt, right? Let's let people know.
Yeah, I mean, a blue belt in jiu-jitsu, let's say you were like a high school and college wrestler and then you went in, because that is going to probably shave like a year off because you grapple better. But I'd say the average person needs a year to get out of white belt. Then you get parked in blue belt you might get parked in blue belt for years. And then you really get parked in purple belt. I mean, some people do like 5 years purple. And then you're brown by the time you're a brown belt, you're almost as good as a black belt. You just don't have like the seasoning, and then you're black belt. So I think that 10 years is a commonly dropped time period to go white to black. But what really ends up happening is And I'm kind of an example. I went in, I did 2.5 years. I went white to kind of like deep blue, and life happened, had kids, buying properties, finding my way, and got tired of being hurt and stopped doing it. And then now I'm back at it. And I've been back at it about a year. And I have a totally different mindset. I have a friend that did the whole Appalachian Trail, and that's Georgia to Maine. And it's like a 2,000 mile something hike. He goes, Ian, if I woke up every day and it was like Georgia to Maine, Georgia to Maine, I would lose my mind. I just have to think like Georgia to like the next little, stop where my girlfriend's going to mail me some chicken noodle soup and some fresh socks to the next stop. Months and months later, I'm finally there. But if I'm thinking about Maine while I'm still hiking Georgia, never going to make it. And I think martial arts is kind of like that. Real estate investing is kind of like that. You need to just focus on excellence at that time and that moment. And look at you. I mean, you focused on your excellence in technology. You tried a bunch of things within technology, but at the end of the day, you're a problem solver. You listening to you for an hour, you don't really fail, but you're failing forward every time. You're learning, you're pivoting when necessary. And now you got a beautiful thing going with this fund, great returns, good lifestyle. So, I mean, complete hats off to you.
Yeah, I'll share one more little anecdote. I sold off at the right time 4 of those buildings that we bought just before mortgage rates started to collapse. One of these buildings didn't sell. Okay. It's like 140 units. It's in East Texas, and it's in distress. And it didn't sell because the market timing was pretty bad, and the buyer went out there and realized this is a piece of crap, right? I'm not going to pay what we thought we could pay. So I had a few choices, and we decided, you know what, this is the one asset we still have. We need to do something with this, and we don't want to sell it at the new prices we're going to get. So we have been actively managing that, or my wife has been actively managing that, I should say, right? And just a few days ago, it was overwhelming. It was like, oh my God, everything's falling apart. We've got like the city's after us, and they're not letting us evict some of these tenants. And it's a lot of Section 8, and we're trying to reposition it to student. There's some big, it's a college town. There's a lot of influx of students because the university is expanding. I was like, okay, let's break it down, right? I know it's overwhelming. And if you think about the whole project, it's pretty scary what's required. But what are we trying to do right now? Let's break it step by step. Right now, there's only one thing we're trying to do. We are trying to get this floor renovated right now. This floor is clean. There's no pest control issues, right? So we're trying to get this floor renovated, and there's these 7 units. Now, there are a couple of issues. The flooring and the subflooring wasn't done correctly, right? Let's just focus on that right now. Let's just fix the flooring next. Once the flooring's done, now let's look at these 7 units on this floor, okay? And let's renovate each one and gut it out completely. And if that's overwhelming, let's just focus on the flooring for now. And next week, let's focus on each individual unit. Once you've got these each 7 individual units, then we'll market test it. Our unit costs right now, we're really struggling with how much to invest in the interior renovations. Is it 5K? Is it 10K? Is it 3K? Let's start at the bottom end and let's see if we can rent these 7. Once we rent these 7, we now have reached a milestone in the project where we've proven we can get an uplift in rents. Then we're going to focus on the next floor, and then the next wing, and the next thing. And then before you know it, we've gone from 7 to 140 plus units completely renovated. But if you look at it as, oh my God, there's 140 units, it is overwhelming. You're not going to be able to sleep at night, especially when you're actively managing a project that's in distress. You just have to break it down. It's just as jiu-jitsu. You've got to think move by move by move. Yes, you want to win, and you want to, tap your opponent or even win the belt, right? And you've got 4 opponents left before you win the belt. Let's just focus on how do I get out of this damn position I'm in. I mean, you screwed up because you ended up here with your hands with your hands out there, right? Let's get out and let's stabilize and let's think about the next move and the next move after. And if you just think about next move, but you have a strategy in mind of where you want to go, you will get there. Every day around my company, it felt like I don't see how this is going to end. This is a struggle, but I have these monthly goals and I have these 10 things I need to do. We're just going to focus on 3. And by doing that, man, I got to a $780 million outcome. But you asked me at any point during that journey, I could have easily have told you it's overwhelming, but I just had to focus on the next task. Let's add another $1 million in revenue. Let's get another 10 customers. Let's bring in that VP of sales we need to hire next to grow my executive team. And when you do it like that, but you have a big strategy in mind, it's crazy what you can accomplish.
That was awesome. I think we should finish on that. That was wonderful, Zain. Everybody, Zain Jaffer, where can people connect with you, learn more, find you?
I have a website called proptechvc.com. You can sign up. I have a newsletter there. I send it out when I can. It's usually monthly or quarterly. It's just an update from me on what's going on in the real estate industry and the technology industry. So proptechvc.com. And there's also a directory of people that invest in proptech if you ever want to start a company and you want to pitch people. I've personally vetted everyone on that list.
PropTech VC, so like property and technology venture capital. So proptechvc.com for Zain Jaffer. Any contact info? Are you taking on capital for your real estate fund?
No, we're not taking on capital for a real estate fund. But best way to connect with me is probably to subscribe to the newsletter, and then I check emails when I can. We got I think 20,000 people on the list, but I try to get back to people when I can. And sometimes we're doing deals. We have our fund, and our fund gets first dib on the deal, obviously, right? But sometimes it doesn't make sense for our fund to do 100% of the deal. So a lot of people operate like this. Maybe our fund will take half the deal. We'll leave another half open to our friendly contacts, and that's part of how we raise money.
Yeah.
Yeah.
I like it. All right, guys, this has been wonderful. Get in touch with Zain. I hope you can tell from this hour he's a wealth of knowledge. I've enjoyed the hell out of this. All right, guys, if you've enjoyed this episode, be sure to rate and subscribe and keep this show going. And for now, this is Coach Brown signing off saying, lace up and leave it all on the field. Yield Coach out.